Welcome to Sierra Capital's Family Office Fundamentals, a podcast dedicated to helping families preserve their legacies and wealth for future generations. I'm your host, Zev Zaretsky, Investment Director at Sierra Capital, a 25-year-old multifamily office focused on guiding ultra-high net worth families globally. In each episode, we'll explore a wide range of topics, including investments, trust and estates, family governance, philanthropy, and much more. Our goal is to provide you with a solid foundation to safeguard your family's financial, intellectual, and human capital for generations to come. Join us on this journey and stay tuned as we hear insightful conversations with industry experts and thought leaders right here on Family Office Fundamentals. Let's embark on this journey together. Please find important disclosures at the end of this podcast. All right, welcome to Family Office Fundamentals. I'm your host, Zev Zaretsky, and today's episode takes you behind the scenes of a panel discussion I was part of at the Small Business Investor Alliance annual conference in Palm Beach. This discussion revolved around the latest SBIC IPC performance report, the same report that we went over in my last podcast. And it provides valuable insights for anyone kind of navigating lower middle market and SBICs in particular. So if you're interested, I've included the link to the full report in the episode's description, or you can go to my last podcast episode as well. All right, well, so since the conference was just a few weeks ago, I thought it would be timely to share a condensed summary along with some key audio clips from the panel. We covered a lot of ground about the report's significance and what it reveals, key trends in the data, current market issues, and even a deep dive into historical loss information. So whether you're an investor in SBICs in the lower middle market, work in CRA or commercial banking, or solely focus on credit, there's plenty of here for you to take away. So let's go ahead and start, and we'll introduce the panel. But before we hear them, the panel was moderated by Tim Rafalovich. He's the head of fund investing at Wells Fargo Strategic Capital.
This is, I think, our 11th annual State of the Market panel, where this, as some of you have understood and known and experienced, we move this really quickly. So, David, a little bit about yourself, and then let's go down the line, your role and company and those kinds of things.
Sure. I'm Managing Director of Investments at Davidson College. Davidson's a little north of Charlotte, North Carolina, about 2,000 undergrads. We have a $1.4 billion endowment. We're one of the first in the country that's not only need blind in admissions, but we meet all need with grants as opposed to loans. And that's what the endowment's there for. I'm one of two on the investment team. I've been there about 7 years, and before that I was at the University of Michigan for 12, and been looking at SBICs for about 10.
Zev.
Nice. So my name is Zev Zaretsky. I'm the CIO at Sierra Capital. We're a 25-year-old multifamily office registered with SEC. Down in Miami. And previously I was treasurer of a bank here in Florida where I started the SBIC program, joined the firm to be the CIO and institutionalize the firm and continue investing in privates.
Thanks. Alex.
Alex Abel, Managing Partner of RCP Advisors. We're a $14 billion fund of funds platform focused exclusively on North America, small market buyout world. And we have done investing in the SBIC program funds as well. And that's it.
Okay, Tyson.
Tyson Smith with Tecum Capital. We're an SBIC out of Pittsburgh. We're currently raising our fourth fund, and I'm here to ask all these gentlemen for money at the end.
All right, so next we're just going to have what the IPC report is, for those of you who don't know, a little summary of it, as well as some of the benchmarks that were used in the report.
The IPC, so we just talked about the IPC report. How many of you are at least familiar with the IPC report? Show of hands. Okay, how many of you actually read the report? How many, two of you? Okay, there's a couple of people. Gail, that's impressive. You actually read it? All 21 pages? Is that what it is? Something like that. So impressive. All right, so let's level set for everybody. Dave, just what's it about in a sentence or two?
Sure. As Greg Brown presented yesterday, we were not going to rehash what he said, but generally we were trying to benchmark SBICs versus non-SBICs. The benchmark we used was the Burgess universes for debt and equity. And we're trying to come to a very simple answer. And I think in the future surveys they will do more work, but how does this universe compare to everyone else?
Yep. We're going to get into practice of that in just a moment. But before we do so, who were the benchmarks on that, Zev?
Yeah, so just to add to what David said, first of all, the report went over mezzanine capital, went over senior lending, also did equity, and then it benchmarked everything with MSCI Burgess data.
Very good. And Alex, Tyson, anything on the format, not the value of it, but the format that you want to speak to?
No, I think the format was great. It was a mixture of data shown in obviously tables and charts, as well as a lot of written explanation of what was done. I think, as I joke with Greg, I always like to see more and more of the underlying data. So, for me, the only thing missing was, massive tables of all the underlying stuff.
You are a stats guy.
I'm a data guy, so that's what I want. But no, I think it was great. It was short and easy to sort of digest, and the summary findings were, pretty obvious.
Yep. Tyson, any comment on the format?
Yeah, I mean, when I took statistics 20 years ago, I'm not sure I knew it then. I certainly don't know it any better now. But the tables and charts really hammered home, I think, what a lot of us theorized is that we have a good story to tell in the program. How can we help do that better with independent data? And the format, I think, for a user that's not familiar with the program was really well laid out, and it's a good handout, leave behind email of anyone who's you're trying to educate them about what an SBIC is and why they should be interested in the program at large. It is a very powerful tool for that.
So I've got a question that may seem a little odd. I'm going to ask you to rate the value of it, and there's a reason that I'm asking you to rate that volume. But before I do that, a lot of the questions yesterday I thought were interesting because they're really asking the modifying variables. So you have these benchmarks and you have the performance. What were the modifying variables? What caused this to take place? So I think over time it'd be interesting to take a look at those modifying variables. But I'm a geek in that way. So.
Okay, so we'll discuss why the findings matter and how they're relevant to different market participants. All right, let's go. So this was great for us, for lower middle market and for SBICs. So for benchmarking, and then also part of our job, right, we're always looking for new clients, is also prospecting, and we do a lot in the financial institution space. And so being able to go to potential investors and say, look, it's not us telling you this. Like, we're not just making up these numbers telling you, oh, these are the funds that we picked. This is how we've done. This is how the actual entire market has done, between the year 2000 and 2020.
Yep, David.
Yeah, I would rate it very highly, like an 8 or 9. I think when you think of dealing with anyone who is not already knowledgeable of this universe, whether you're prospecting for GPs or LPs, you have to answer that fundamental question of why should I pay attention? And when you can show outperformance consistently across all sorts of strategies, and it's a very simple thesis, like this leverage can subsidize your returns, it gets people's attention.
So one of the comments I'll make to you GPs out there, you might think, okay, that was interesting statistics, but I'm not sure what to do with it, and we'll talk about what to do with it in just a second. But this is, from an LP standpoint, very helpful, because you do, especially with anybody that has multiple assets, asset classes, being able to benchmark and take a look at how this performs versus others is probably underplayed in your minds compared to what I think others see in this.
Okay, so now we'll highlight key takeaways from the data and why paying attention to detail is critical, particularly in the space of lower middle market. So let's keep it rolling.
All right, Tyson, starting with you, a number, a data. What stood out to you that was really interesting that may have been underplayed? And you could talk about the basic, 15.5% or how much, but any way you want to take that, what stood out to you?
Yeah, I think the interesting thing for those of you that didn't complete the survey was the backstory here with Greg and his team was there's a lot of discussion on what data we should ask for. I think we wanted to ask for 100 things, but then how many folks would have returned the file, right? So because of that, we had to simplify down the data collection points. So I think that was the interesting thing to me was, with the sample size, you had to bucket into certain ranges. And I think there's a big difference between 0% equity SBIC and 20% equity SBIC, but they're in the same bucket, right? I think there's a big difference between folks that recycle a lot and folks that don't. There's a big difference between folks that get a bunch of warrants in their model, which isn't really right. So there's all these nuances. I think as a general overview of the SBIC, it's an incredibly helpful document. If you started to nerd out as a fund manager and think, okay, well, this is just the return side. What about the risk? Because we do more unitranche. So a lot of our debt is not as risky as those like hardcore mezz guys. You start to talk yourself in circular references as you nerd out on it. But the biggest thing to me was just what we all know is that the leverage is a positive, and I think it helped to put that in perspective of just how much it can be versus those benchmarks.
Great, Alex, what number stood out to you?
Well, I think there's a chart in there that shows the leverage ratios sort of broken down by category, the excess returns of each of the sort of buckets of leverage ratios. And one interesting thing is the highest leverage ratio actually often did not return the highest excess, right? Now, part of that could be an issue of sort of negative dispersion that might be attached to some of that as well, right? And so that's bringing averages down. But it's interesting because, again, like you would have expected the highest leverage levels to sort of generate the highest returns, and that's not always the case.
Yep.
Yeah, for me, actually, I was going to say the exact same thing. It's
too bad.
Really, I would just expect, right? If it's 2 times levered, it's going to be better. I think it was like 1.5 or 1.25 was actually the highest returning funds. But there's so many nuanced, things that obviously you just have to look at the actual fund itself to figure out why. Maybe it's the use of leverage early on, or
I think it's also a big in this program, as people know, like strategy-wise, the folks that are getting those higher level leverages are actually generally lower return targeted strategies, right? So the equity, more pure equity folks, or folks that are using a significant amount of equity, are generally at a 1-to-1, and that's how this was calculated. So that might be part of it as well.
Yeah. But also, if you look at just the actual returns, I think it might be like the second or third table. It shows you what the excess returns are versus the benchmark. And it was on junior capital was the highest IRR, excess return. I think it was over 500 basis points of excess return for junior capital, where I think it came out to 0.7 times multiple. But for equity, it was only maybe 300 basis points of excess return, but it was a full turn, if not more, of multiple expansion. So,
for me, I would say a couple things. All of the averages, like from my perspective, I'm looking at the levered funds. That's part of why we all, there are plenty of good reasons to raise an unlevered fund. But, the thesis is, does the leverage give you higher returns? And if that's the question you're asking, then all of the averages are understated in terms of excess return because it includes unlevered funds in there. And one interesting data point was in the more equity-heavy funds. In that 0 to 10 bucket, that, I don't know why, and it'd be a good question to ask in a future study, but that bucket underperformed. So that, for equity strategy ones, that even drove the average even further down. When you look to the right, when you looked at the higher levels of leverage, the average excess return for those different things, for those different buckets, ranged from like 5 to 10%. So like, it could be meaningfully understating how much the excess return was there for equity-oriented funds.
Yeah, to be clear on that, I think the 0 to 10% still overperformed compared to the benchmarks. Just underperformed compared to...
Not in the equity category.
Okay, yeah. And I think the accrual program, because it was stated that it's not a statistically significant number around accrual. So when an accrual program, I think you're going to see
there's no accruals in the because it's ended with 2020 vintage year.
And the one we didn't say, Tim, which jumped out to me too, was the larger funds outperform the smaller funds, which I think intuitively there could be arguments both ways on whether you would have guessed that would have been the case or not.
I forget how it goes, but the curve that goes like convolulinear, something like that, I don't know. But I think you would probably actually find that if you got too big of a fund, you don't take care of the leverage, or you don't take advantage of the leverage as much. So those might go down. But again, we didn't see that type of graph on here.
All of these variables are interacting. Like if you're a successful manager, next time you're going to raise a slightly larger fund, maybe the leverage is still relevant, but your leverage ratio goes down.
All right, so now we'll hear how limited partners, or LPs, use this data to inform strategies going forward.
So as an LP, let's talk about LPs. How are you utilizing this? Because I want GPs here to be aware how you might be able to utilize that. Zev, start with you, and then David, how do you use this internally? I think you've already answered that question, but maybe in a sentence or two.
Yeah, well, so from our perspective, it's getting investors actually comfortable. To your point, like, yeah, you used to have to rely on that SBIA report that was like 2016 or 2018. They came out with one report. It was one page. It didn't have any sources, how many funds were talked about, but it did quartile out the returns on a single chart, which was nice. So now that we have this report, it's like so much easier, so much more relevant. But yeah, so for me, obviously benchmarking, and then it's going to be being able to talk about the actual returns of the program over time. Back when I was working at a bank, just to be able to get an investment approved at a bank. I'm talking about just an agency mortgage-backed type of security that, not an MBS, but maybe it was like some type of commercial mortgage-backed security. If it didn't have 25 years of historical, data that we could look at, I couldn't get it anywhere. And so, as GPs go and talk to banks or talk to other institutions to invest into their fund, having this historical data obviously just kind of changes the game.
Yep, David.
Yeah, the same with me. I've shared this with my stakeholders, with my investment committee. It's not just me saying it. And it's greatly appreciated. It was a very high sample set. I think, Greg mentioned yesterday is a little less than 70% response rate. But I think if you actually I looked through the data because in addition to Alex, bugging all of you that are SBIA members, I was pleading with all the non-SBIA members who had like defunct funds from 15 years ago, please send us data. And so we could look through that, and we saw if you looked at institutional funds that raised more than 25 million in LP capital, and you looked at things that were investable, like not fully BDC owned or not bank owned, we captured way more. It's like more like 85% of all of the funds.
Mm-hmm.
All right, so now we'll explore the issues and trends limited partners are encountering in today's market. Really, it's not just limited partners, also general partners. We do a little bit of co-investing at Sierra Capital, so we also see underlying businesses as if we're a fund investing in one asset. So, yeah, pretty interesting conversation. Let's go ahead and give it a listen.
All right, moving on to other trends. Let's take a look in the middle here. Alex, Zev, let's talk about maybe a trend that concerns you. What trend, Zev, starting with you, maybe a trend that concerns you a little bit that you got your eye on? Yeah.
So being in my seat, it's pretty cool because you get to touch a bunch of different asset classes. Like we're invested for our clients, from equities down to co-investments. And so we have some co-investments on our books that it's cool because we get to see what's going on with the actual businesses and businesses that were done, that were purchased in like 2019 to 2021, kind of like have caught my eye. And so when I then put that into the SBIC world, just talking about like a normal multi-strategy fund doing 75% debt, 25% equity, right? I'm really starting to question, for deals that were done 2019 and 2021, what's really going to happen to that equity? What's going to be the return of that equity, and what's it going to do to the performance, whether it be the multiple or the IRR? I think on the debt side, I'm not really concerned. I think that banks have done a good job of working with different types of mezz lenders to work out deals, push things down the road. But that's also made a lot of this mezz debt turn into PIK. So PIK's becoming a bigger deal, less cash return, and with the equity. So we'll see what happens. I think that it'll be an interesting multiple years of vintage funds that it's going to be interesting to look at. But in terms of like broad-based concern, I'm still sleeping at night.
Got it. Alex, concern?
Yeah, I mean, there's a couple, I guess, but the one I'll mention is I think continuation vehicles this is a tool that GPs have been using more and more over the last 5 to 7 years. Used to be that these types of transactions were for restructurings, right? We call them restructurings, not single asset deals. They're for the problematic deals within portfolios. Now, of course, they generally are actually the higher performing companies. And like any good tool, it can be used for good or evil. And there are CVs that we invest in ourselves that are very good investments where there's a great deal of alignment between the general partner and the LPs or new investors into that new vehicle. And there's a ton of GP CVs that are sort of evil because the alignment's not there. It's a money grab for the GPs, a fee grab oftentimes. Sometimes carry is not aligned correctly. So I think like as any new tool enters the marketplace, I think we are going to see some of these CVs that have happened over the last 5 to 7 years do quite well, and there's going to be a shakeout. We already started to see that a little bit with some of these that were not structured well, that were done, and especially more recently, as liquidity went down significantly over the last 2 years. These were ways of creating sort of, frankly, artificial liquidity in managers' portfolios. And as LPs, we are very well aware of that. And so there's a number of folks that, for example, are in our portfolios that we have counseled against doing these, or a very specific type of these that we thought was inappropriate. And they did it anyways. They got their liquidity, but these are managers that we will not be re-upping with, right? And so, like, if LPs are not stupid, right? We can see whether the liquidity is real or not. So I think that's the biggest worry that me is that we're seeing a lot of generation of sort of artificial liquidity out of a desperate need to raise their next funds.
Yeah, so I think what Alex is talking about there is actually really important, something that we've seen a lot of with these continuation vehicles or even funds that are still in the investment period buying assets from funds that are out of the investment period. It's pretty interesting. But yeah, so now we're going to jump into, so if you're not in the game, then you probably never made any mistakes. So what are some mistakes? How have things changed over your time in the space?
Just in respect to my due diligence, how it's shifted and how it's changed over time has really kind of been like a testament to, like sometimes you invest in good funds, sometimes you invest in bad funds. And so now to your point that you were talking about before, Alex, about like independent sponsors and how that's all starting to shift. I think that now my diligence is actually starting to focus, okay, so yes, this is your fund, these are the type of investments you do, this is your historical track record, that's great. Who is it that you're actually doing most of your deals with? And if there is some type of concentration, do I need to now underwrite the underlying manager that if you're doing all independent sponsor deals and it's a lot of it with one guy, I should really know what their strategy is as well, not just your strategy in underwriting their debt.
Alex?
Yeah, I think recently over the last 6 to 12 months, I think we've seen a number of managers who have had historically spectacular track records who had some troubled portfolios. And I think one of the mistakes we made a little bit was, sort of conviction in those managers' abilities to actually turn some of those portfolios around because of that historical track record. And what we also find sometimes, and this is a good learning lesson, is that sometimes people who have never had that adversity aren't really good at managing it when it comes. So you might have had 2 funds where you never had a problem in your portfolio and your no loss ratio even in some cases. And you know what? Like not having had to go through that is actually a really a detriment to when it does happen, right? And people oftentimes don't react quick enough. They're not, there's a little bit of hubris there, right, as well. So we found that some of the managers that we've been monitoring over the last year where we think, oh, they're going to turn that around, we're now a year later and it's gotten either the same or worse. And I think that, and again, not a lot of action items as an LP, of course, except for the next fund, but our monitoring of that, I think, is going to become much more.
All right, so that was pretty interesting. Our next section was part of a Q&A session that was with the audience. And there was one audience member who asked a lot about risk, and he asked a lot about historical losses and loss ratios. And that's kind of where Tim, the moderator from Wells Fargo, took the reins and kind of dropped some knowledge and some good data points. So for those in risk management, there's a few standout data points that you'll want to pay close attention to.
First of all, thanks for your thoughts today. I think talking about the performance, we talked about the positives. I think one of the things when we're marketing is to understand some of the negatives, which I actually think is a positive in this world, which as a fund in formation, which would be around default rates. There is some mentions here and there on the cusp, but not as much out and open. I'd love to hear your experiences. I think, Alex, you mentioned one where there was some restructuring that had to go on within the portfolio. But
Are you asking for percentages or why they somebody defaults?
Not so much on the going with the data-driven approach is what are the numbers like? I mean, I've seen on the SBA website, they have some numbers around defaults, but there tend to be, basis points.
We did analysis 2018, maybe 2016, somewhere around there, where we went back on all of our funds and looked at underlying asset losses. And this was including through the Great Recession, and the average was 6% across principal losses across the entire portfolio, and much of that, about 40% of that was recovered. We also looked at equity, and it was closer to about 18% of those companies lost some type of principal. But we actually segmented just between the years of 2004 through 2007 into the teeth of the recession, and the loss rates for there was 16%. And then for equity, I think it was 24%. And then we modeled all of that out and said, if a fund invested in the absolute worst years and continued to go through the worst years, what would that, and it was a 4% IRR, even through the worst years. And then currently we look at what does a fund need to lose in terms of principal balances, and this is something that didn't come up today, but I think is worth looking at. Do your own modeling and your own assumptions, and say how much principal balance can we lose, assuming certain types of recovery rates, and still break even. And you'll see sometimes it's somewhere between 32 and 42%. And when you tell that in debt, largely debt, some of you are equity, but whatever your loss rates are, and then you look at, the likelihood of that taking place, pretty small. It's a good story to tell.
No, I agree. I think that they've pointed.
All right, so I thought that was super helpful, and I appreciate hearing that. Finally, we'll address a big question. Does historical data hold value, especially considering not all SBICs reported? It's probably a question that a lot of investors or potential investors say to themselves. Look, you don't have all the data. There's probably a couple zeros in there. Maybe the IRRs aren't that high. The outperformance really wasn't that great. So let's go ahead and give that a listen. I thought that was pretty interesting too.
Hey, so quick question back on the returns data stuff that we started with. I think like a lot of people in this room, I'm familiar with the high-level conclusions, and I've sat through kind of the presentation. I haven't read the nitty-gritty. I'll share with you that 3 or 4 times I've kind of cited the outperformance data with an educated consumer. I get one comment quickly back, which is, oh, well, they threw out, it's only 70%, so the 30% that didn't report must be zeros, so I don't pay any attention to this at all. So that's clearly a little bit of a pessimistic view to hear back. But what is to someone who has actually read through all this stuff, what's an appropriate rebuttal to that argument?
Well, one rebuttal is that one of the things that, I don't know if Greg's still here, I think he might have gone, but one of the things that they did was they looked at actually the underlying Burgess data, right? So which is reported by LPs who hold SBICs. And it was a smaller sample set. It was 85-ish.
Yeah, the idea was Burgess collects data from LPs because Burgess does some of their back office performance calculation. So there were a sample size of 80-some SBICs within the Burgess data. So that would presumably have no sampling bias relative to the underlying.
It's only like self-reporting bias.
Yeah.
Yeah. Because good ones or bad ones would be in there.
I think also you could look at the 2016 SBA report, the tables there, because it was like a 200 basis point difference in the average IRR. I'm talking about the one that actually quartiled everything, even though it was only one page. That one, I don't think had survivorship bias.
When you're capturing 70, 80% of the entire population, the rest of that truly does have to have just an extreme sampling bias for the average statistics not to be somewhat relevant.
Agreed on that. If you're doing a phone call poll or something like that, 70% should predict the 100% pretty well. But when it's self-reported, and you have to assume that, why would someone not self-report?
Ask them if they use Cambridge's benchmark. Cambridge's benchmarks represent 8% of the private equity universe. I mean,
Yeah.
so like that's also all self-reported. Like it's only managers that they're either invested in.
I
or
got another
decide
answer
to
for that.
report.
Just say, you know what, I'll just go to another LP.
No, I mean, like, look,
That's a hard.
Burgess's data is actually better than Cambridge's
Yes.
for smaller funds.
That's right. I agree with that.
And, you know, why they didn't report? We got a very high return rate from SBIA members, people who are still in the program and are incented to do it. We got a very low return rate from non-SBIA members and people who are at defunct firms who don't want to go dig out the data because they have no interest in the program anymore. I can tell you just anecdotally, like, I know plenty of the firms that didn't report, and they have great data.
Yeah.
All right, guys. Well, I think that's pretty much it. We're hitting half an hour. Thanks for tuning in to this episode of Family Office Fundamentals. I hope you found these insights into the SBIC IPC performance report as valuable as I did. Also, the other discussions that we had. Whether you're an investor, a lender, or just curious about the lower middle market, understanding this data is pretty key to navigating today's opportunities and challenges, and then also just benchmarking yourself or how other investments are doing. So, if you'd like to dive deeper, check out the report link in the description. Don't forget to subscribe, share, and join us next time for more insights into family office investing. See you soon. The information presented in this podcast is the opinion of Sierra Capital and does not reflect the view of any other person or entity. The information provided is believed to be from reliable sources, but no liability is accepted for any inaccuracies. This is for information purposes only and should not be construed as an investment recommendation.